There are 5 tax strategies written directly into the tax code right now that your accountant either doesn't know about or doesn't implement or flat out told you couldn't work for you. That silence from your accountant is costing the average business owner somewhere between $15,000 and $50,000 a year. So by the end of this video, you'll know exactly what each one is and exactly where the guardrails are, because that's the part that people never get told. Real quick, I want to address the word loopholes. I hate that word. These are not loopholes. These are incentives. Congress built them right into the tax code on purpose to reward specific business behavior. So we're not bending anything, we're not stretching anything, we're just walking through doors the government left open. But here's what matters. If you don't follow the rules to the letter, the deduction gets disallowed fast, and you've got a mess on your hands. So we're covering all 5 today, what each strategy is, what makes it work, and what breaks it. Think about the tax code like a building with doors that are open to any qualifying business owner right now. Most business owners walk past all of these doors every single year because nobody pointed them out. We're going through 5 of those doors today, and I'm handing you the key to each one of them. So strategy number 1, 100% first year deduction on a vehicle purchase. The reaction I get from clients the first time I walk them through this is always the same. You're telling me I can buy an $80,000 truck or $150,000 G-Wagon and write the whole thing off this year? Yes, if you follow the rules. Here's how it works. Congress passed the One Big Beautiful Bill Act in 2025, and it restored 100% bonus depreciation for qualifying business property placed in service after January 19th of 2025. So this is fully in effect right now. The Section 179 limit for 2026 sits at $2.56 million. So this applies to vehicles, equipment, all sorts of things. But most business owners aren't anywhere near the ceiling of this thing. So for vehicles, the qualifying rule is pretty straightforward. If your gross vehicle weight rating, which is printed right on the inside of the door, is over 6,000 pounds, which covers most full-size pickup trucks, your SUVs, your F-150s, your Tahoe, your Suburban, your Escalade, or my personal favorite, Porsche Cayenne Turbo, they all qualify. So here's the math on a real example. You buy a $80,000 Tahoe. You use it 80% for your business. You are allowed to deduct 80% of that cost. So at a 32% tax bracket, we're talking a $64,000 deduction. It's $20,000 back in your pocket this year instead of spreading small deductions across 5 to 7 years for a vehicle. This timing advantage is huge and it's worth real money. But we see 2 things that kill this strategy. The first is you don't have a mileage log. And I mean like a contemporaneous log, which means you track the miles as you incur them, not something you reconstruct in April when your CPA calls. The second is business use. You got to keep it above 51%. Now, the full business use is deductible. If you use this vehicle 100% for business, you could write off the full cost of it. But if you fall below that 50% threshold, you're not going to qualify for accelerated depreciation at all. And yes, of course, if you sell the vehicle later, you have what's called depreciation recapture. But for most people, this isn't a big deal because they're just going to trade in that car and buy a new one and upgrade. This is why you see a lot of business owners driving new big vehicles every couple of years. But depreciation recapture can be part of the planning conversation. And it's not a surprise you want to find out later when you get a letter from the IRS. Strategy number 2, hiring your children and paying them tax-free. I know how that sounds, but stay with me on this. For 2026, the standard deduction for a single filer is $16,100. Your children can earn up to $16,100 working in your business and pay 0 federal income tax on that. You, the business owner, get to deduct every dollar as a legitimate expense. So that money that would have been taxed at your rate, let's say it's 32%, gets moved to your child's column at a 0% rate. So that's over $5,000 in savings if you're maximizing this amount. And that's per child per year. So if you're operating a sole proprietor or a single member LLC that's taxed as a sole prop, it gets even better. Under the IRS rules, the wages you pay to a child under 18 are completely exempt from Social Security and Medicare taxes too. So this is the 15.3% FICA that normally applies to every dollar on payroll. It's exempt under those circumstances. So on $16,100 of wages, that's another $2,400 that doesn't leave your business. So the total benefit could be over $7,600 per child per year on wages you were already going to give them as an allowance anyway. Now, if you're an S-Corp, the FICA exemption goes away. Payroll taxes apply regardless of the child's age in a corporate structure, but the income shift benefit still works and is still worth doing for a lot of taxpayers. But the payroll tax piece isn't going to apply here. Either way, you do need a W-2 for your child, not a 1099. There's different rules for 1099s and different benefits that are available, but you also need to make sure you have a real job description, documented hours, and you pay a reasonable rate, which means it should sort of match what you'd pay a non-family member for the same work. So fake jobs, inflated salaries are some of the first things that an auditor from the IRS is trained to find. So here's what to think about beyond just this year's return. Those wages are earned income. That means your child can also fund a Roth IRA, helping them save for retirement, building real wealth. So for 2026, the contribution limit is $7,500. So your 14-year-old putting $7,500 a year into a Roth IRA at 8% returns could have $3 million by retirement age. The strategy pays for itself in year one and builds something in the background that most families never create, which is generational wealth. And if your child's earning enough, you can stack the Roth contribution on top of the standard deduction, pay them even more, and minimize the tax bill. So we've covered two of these, and before I get into the next three, I want to stop for 10 seconds. Our team at Pennywise put together a free guide called 7 Tax Strategies Tax Preparer Probably Isn't Telling You About. And 2 of these 7 we haven't even touched in this video at all. But one of them is a provision in the tax code named after a former president that lets you rent your home to your business completely tax-free. We love that one. The other is a savings account most business owners barely use that's tax-free going in, tax-free while it grows, and tax-free when you take the money out. Neither of those are in this video, but both of them are in the guide. It's a PDF, it goes straight to your inbox, there's no pitch inside, just strategies that you can take a look at and see if they actually hit your tax return. All right, let's get back to the remaining 3 strategies, because number 4 is the one with the biggest dollar amounts. So strategy number 3 that seems illegal, but isn't. Turning business travel into a tax deduction. The IRS doesn't really care where you go, they care why you went. That's the whole framework here. So if the primary purpose of your trip is business and the majority of your days on that trip are business days, your travel is deductible for domestic purposes. Your flights are fully deductible, your hotel, meals are 50% deductible. And if you fly first class, that's fine because Congress didn't write an economy only clause into the tax code. If your family comes with you and they don't work in your business, their flights and expenses aren't a deduction, but yours still are. So document your business days, keep your meeting agendas, your calendar of business activities, and the written purpose behind the trip. That's the documentation that you want to have. And if your family is employed in your business, you want to keep the same documentation for them to justify the trip. And that's your defense file if this question ever comes up under review from the IRS. For international travel, the rules tighten. It's at least 75% of your trip. Those days need to be business days for the full expense deduction. So if you're mixing in significant personal time on an overseas trip, you'll need to split costs between business and personal. But if you run it correctly, a conference in London, a client visit in Tokyo, a real estate tour in Mexico, all of it's deductible. The location is completely irrelevant. The documentation is everything. Strategy number 4, the short-term rental strategy. This is the one I mentioned a minute ago. Let me show you the numbers. Under IRS section 469, rental properties are classified as passive activities. That means that the losses that most rental activities show because of depreciation and from other operating costs, they can't offset your W-2 income or your business income. Typically, they just kind of stack up and wait for future passive income to absorb them. But for a high income earner, that's a dead deduction for years. But there's an exception in the code. If your average guest stay is 7 days or fewer, the IRS no longer treats that property as a rental activity at all. So under traditional real estate, if you're going to sign a 12-month lease with a tenant, it's still going to be considered passive. But if you keep it under the 7 days, now we're talking a different type of business. You're now in the hospitality business. And if you materially participate in running that business, the losses become non-passive. They actually reduce your taxable ordinary income directly. So here's the math. If you purchase a $500,000, $500,000 short-term rental property, you can do what's called a cost segregation study. It's an engineering analysis that identifies which components of the property qualify for faster depreciation schedules. Can often be 25 to 30% of the purchase price. And some of those may even be eligible for 100% bonus depreciation. So on a $500,000 property, that's 125 to 150,000 in year 1 deductions. So at a 37% federal bracket, That's $46,000 to $55,000 in savings in year one if you buy a short-term rental and place it into service. So on a property that's simultaneously generating like Airbnb income, that's the combination that changes the math for high earners. And I know exactly what's going through your head right now. You're thinking, okay, Adam, so I just bought a cabin, I put it on Airbnb and I'm done. Well, it doesn't exactly work that way. Here's what actually kills this strategy. Material participation is a legal standard, not a feeling. You need to log at least 100 hours on the property during the tax year, and no other individual can put in more hours on that property than you do. So you've got some work to do. This means that you're running the property, you're communicating with guests, you're coordinating cleaners, managing the listing, you're handling issues, and you're logging every hour of it in real time. If you hand it off to a property management company and go completely hands off, your losses will likely revert to passive and you've got those limitations again. So this strategy requires your actual involvement, or maybe the involvement of your spouse, not just your name on the deed. And one more thing that surprises a lot of people here, you don't need real estate professional status for this to work. You hear about that a lot on the internet. That's a separate designation requiring 750 hours across all of your real estate activities and with real estate as your primary occupation. But that's where we can capture the benefits from long-term rentals. Obviously, it's a lot more work. That strategy is built on a completely different code section. So if you're a physician, an attorney, a business owner with a W-2 and active income, you can qualify through material participation alone without having to work 750 hours in this business. You don't have to completely change careers. Strategy number 5, the home office deduction, specifically as it relates to S corporations. This is one of my favorites because we hear a lot of accountants tell their now prior clients, if you've got an S corp, you can't take the home office deduction. We probably hear this 3 times a week at Pennywise, and it frustrates us every time because the answer is in the tax code. So if you're a sole proprietor, the deduction's pretty straightforward. You calculate your square footage of the space that you use regularly and exclusively for business, your home office. And that's a percentage of the size of your total home. So if you got a 2,000 square foot home and your office is 200 square feet, you can deduct 10% of your rent, your utilities, your homeowner's insurance, your mortgage interest, repairs, maintenance, all sorts of things. So if you're spending $3,000 a month on housing costs, that's a $3,600 a year deduction that you can take. There's a more advanced way to do this, which is almost always worth more than this simplified method, but that's going to cap out at $1,500 a year. There's a simplified method to do this too, but it's going to limit you to like $5 a square foot. So it's usually worth doing the extra math to capture the full benefit on this. But here's the S corp piece. Your accountant tells you the home office isn't a deduction because that doesn't work with S corps. Technically, that's correct. But what they're not telling you is that there's another way to accomplish the exact same goal. This is through what's called an accountable plan. The IRS recognizes accountable plans as the system that your business uses to reimburse employees for expenses. So in this instance, your S corp would reimburse you for the use of your home office. The math is the same. The amount you get to deduct is the same. It's just a slightly different path to get there. So you need to have your accountable plan documented for your entire business. You need to document the business use of your home, and you can reimburse yourself from your company and take that tax deduction. You then don't report it as income on your personal taxes. It's excluded from your personal taxable income. So the financial result is identical. It's a different path with the same destination. That's not a workaround. That's the code doing exactly what it was designed to do. And your accountant's job is to know that. So before I give you the summary, let me run through the 3 mistakes I see across all 5 of these strategies. Mistake number 1, no documentation at the time the expense occurs. Not next week, not during tax season. You need what the IRS calls contemporaneous records, meaning at the same time. So we're talking about mileage logs, time logs for your real estate participation, your meeting agendas for travel, your job descriptions, your timesheets for your kids on payroll. If you can't prove it at the time that you incurred the expense, you're going to have a hard time holding it up later. Mistake number 2, assuming the strategy works the same way regardless of your entity structure. The kids on payroll or employing your kids strategy is different for single member LLCs versus S corporations. The benefits are different. The paperwork that you have to file is different. The home office path changes depending on which type of entity you have. The vehicle rules can be consistent, but may also be part of an accountable plan where there's a reimbursement from your business. So you got to understand your entity before you deploy any of these. Mistake number 3, treating this all as a one-time setup. Set it and forget it, as my wife likes to say. The average guest stay on your short-term rental, for example, should be calculated every single year. The business use percentage on your vehicle needs to be logged basically every time you drive it, and the calculation needs to be done every year. Your material participation hours must be tracked every month. One bad year on the documentation, and you don't just lose that year's deduction, you can be putting other years' deductions at risk. So here's where we land. Vehicle depreciation, employing your kids, business travel, short-term rentals, and the home office. All 5 written into the tax code, all 5 available to you right now. None of them super complicated in concept, and all of them requiring real documentation and real execution to hold up. The entrepreneurs who keep more of what they earn aren't smarter than you. They're just running strategies the tax code already offered them because someone taught them about them. The fire doesn't warm the room before you put wood on it. You put the wood on first, and these 5 strategies are the wood. If you're sitting on consistent profit and you haven't had a real tax strategy conversation this year, that's the next step. My team at Pennywise Tax Strategies works with business owners on exactly this kind of planning. The link is below. And if this changed the way you're thinking about what the tax code actually allows, hit subscribe. There's a lot more where this came from.